Hello, I'm Professor Donna Byrne, and this is an estate and gift tax video, even though it's about income tax. We're just going to do some practice problems. Now, if you missed the first couple of videos, here are the YouTube links. They're both on YouTube. You may have to go to my PowerPoint in order to get to something you can click on, but that's where we actually explain these concepts. Now, these practice problems will give us an opportunity to play around with basis, with amount realized, and the concepts of gain or loss. We'll be using section 1001A, so if you have access to your code, that would be a good thing to have open. Okay, the problems I'm using are from Wilbank's Federal Taxation of Wealth Transfers, 3rd edition. Okay, first one. Angela purchases some stock for $100,000, and the stock goes up in value, which is what we always want, and then she sells it for $300,000. She sells it to Barbara, and we want to know income tax consequences for Angela and Barbara. And that usually means, does somebody have gain, loss, income, deductions? What kind of gain is it? What's the basis in property you end up with? Any of these are income tax consequences. And so if we just ask that, you explain everything you can about the transaction. Okay, so our first question then is, what was Angela's basis? Angela has disposed of an asset, and so we want to determine whether she has a gain or loss. And we know that we need to know her basis, and we need to know amount realized. So she bought this for $100,000, and that is her basis. This is a cost basis. It's the amount she paid, and section 1012 gives us this. This is our starting point. Now, what is Angela's amount realized? Remember, she sold the property to Barbara for $300,000. So amount realized is what she got, and that means that her gain, we can now calculate. Gain is the excess of amount realized over the adjusted basis. That's such poetry. All right. So the excess of amount realized over adjusted basis. In other words, amount realized minus adjusted basis, but not below zero. All right. So 300 minus 100 is $200,000. Now, Barbara, our other party to this transaction, just purchased the stock for $300,000. There's no tax consequences to purchasing something, except that she now has a basis in the stock, and this is also a cost basis of $300,000. So the income tax consequences for Barbara really kick in when she sells the stock later for $350. Her amount realized is the $350. That's the easy part. And then we subtract her basis. We look back to see how she got the stock. She bought it for $300, so that's her basis. So we have $50,000 of gain. Okay. Now, what if instead Angela were to give the stock to Barbara? And we'll posit that she's not going to pay any gift tax. We want to know, what are the income tax consequences to Angela and Barbara. Well, Angela made a gift. She does not have to recognize any gain, even though she disposed of property. And that seems appropriate. There's no amount realized. So it's not explicitly stated, but when she makes a gift, she does not recognize any gain. Barbara has received a gift. And we know that under the income tax, gifts are excluded from gross income under section 102. So Barbara has no tax consequences at this point, except that she has a basis in this property. And we need to figure out what that is. Okay? So here we go to section 1015 instead of 1012. 1015 is the rule for basis for property received as a gift. And the general rule is that Barbara's basis is the same as her donor's. So in other words, she gets Angela's basis of $100,000. And now we can determine what happens when she sells the stock for $350,000. All right, amount realized minus adjusted basis. So her amount realized is $350. That's what she got. Always start with the part that's obvious from the problem. And then her basis, we have to look back and say, how did she get this stock? And we say, oh, okay, she received it as a gift from Angela. Well, what was Angela's basis? Because 1015 says that we use the donor's basis most of the time. So gain is $250,000. Here's the summary. On the left, received the gift, and on the right, bought the stock for $300,000. And then we're selling it for $350,000. Amount realized is the same in both cases. That's what she got. The thing that's different is her basis, and that's because she received the property, or she acquired the property, the stock, in different ways. When she acquired it as a gift, she got the donor's basis over here on the left of $100,000. And when she acquired it by purchase, she has a cost basis of $300,000. And so that makes all the difference in the world when we're determining her gain.